Hi, Neil Rose. Thanks for watching. I just wanted to expand on not just the letter that went out recently, but the one before in July, and a sort of a theme this year. Um, First, some observations about the markets, and the stock market gets all the attention, but this is really a historic bond um, bear market. Uh, Obviously, inflation has a lot to do with it. Uh, Good reminder here, actually, with inflation, that risk is what's left over after we've considered everything. And 2 years ago or a year ago, people and especially policymakers totally wrote off the possibility of inflation. Now it's the biggest issue of the day, biggest threat. Just like 2 years before that, nobody thought of a global pandemic as a possibility, or didn't factor it into work. And how could you? So your risk are the things that we can't think about. Um, but here we are, 2022, and the story of the year is the bond market. Fed is fighting inflation with 0.75% increases recently. It's expected to do one or two more hikes of 0.75, or maybe 0.75 and then 0.50 by the end of the year. The federal funds rate is going up. Zero first quarter this year, and now we're at 3% and climbing. Those rate increases are taking money out of the stock market and out of the economy in general. So all the flooding of cash with quantitative easing and all the creative ways they put money into the economy now coming out. Probably has a long way to go before uh, monetary levels or the balance sheets of central banks get to something close to where it was in just recent times. The explosion of money has been so great, but higher interest rates, uh, money coming out of the economy. A little surprised that asset prices are going down, even as inflation goes up. The Fed, when they raise rates and central banks raise rates, usually something breaks, something unexpected. The Fed has more or less acknowledged that for them to cure inflation, they need to sort of wreck the economy and the markets. Um, we might be in a recession now. There's debate about that, but most investors and most pundits and economists have figured on an inflation, although they all think it's mild. So, um, true to form, there's a possibility that most people are wrong most of the time. So who knows? It could be a much worse recession, or it can be not much at all. If the Fed blinks, numbers start to go down. They blink and you stop jawboning higher rates and all that. Who knows? Thankfully, we're not in that position, as sort of laid out before. Uh, all of this horrific bond action, and here you can see this is by far the worst bond market ever. And unlike previous bear markets in stocks, this one isn't sort of being accommodated by a rise in bond prices, which we talked long ago about, and many times about why at some point the bond market not only has to stop accommodating stocks, but can be risky, or the riskiest of all, because of interest rates. When interest rates are zero, there's not much upside in bonds. They were certainly priced for perfection. We had 14 trillion in bonds in the world between Europe and Japan that had a negative interest rate at one point. And investors only gobbled up more bonds. So uh, when you're in these indexes, uh, where they, or these markets, or these funds that generally have a diversified bond holdings, a good chunk of those bonds, 25% or more, are in long-term bonds, things maturing more than 10 years. We've only had about 3 to 4% of our bond exposure in 10-year and over paper. And if you think about, bonds are just a half or so of the portfolio, our actual exposure to the portfolio as a whole has been less. So rising rates, when you have a bunch of short-term bonds and cash equivalents and T-bills, um, higher rates are a great thing. Our earnings power, both income and total return over the longer term, has increased. Um, I mean, in a big way. So it's another kind of visual of how far up we've come in yields. At the beginning of the year, T-bills and short-term treasuries had virtually no yield. That's in the green. The purple was the 3-year treasury, which had a yield not much more than 1% at the beginning of the year. Now it's over 4.5. And you've had similar kinds of moves, or similar rates now in even longer term bonds. We're seeing some things, especially in corporates, where finally there's a nice and growing spread between corporates and the corresponding treasuries. But corporates out there, not long term, maybe medium term. We're seeing 5, 6, 6.5%. Been adding to it here and there, which in the short term is only shown more losses, but here and there, I think we are looking at a situation where we are paying a relatively small price for years of higher income. When your income generation goes up 3 percentage points a year, that's meaningful, and that's something we're paying for in a way. I think before it's all said and done, we might see a little bit higher yields, especially on maybe on the longer term, definitely the shorter term, and we'll only add to those issues. And so the trick now is to sort of parlay into um, you know more longer term bonds, certainly medium term bonds, and not have plurality of the money well under 3 years on average. So we'll extend those yields, but the portfolio as a whole now, I think, are maybe yielding 4%, whereas a year and a half ago, I think average portfolio yield was 1 to 1.5, and that's kind of where it's been for many years now. Now we're earning over 4%, and um, maybe it'll go up. So I think in the context of the long term, our uh, our risks, whether it's inflation or outliving our money and all that, the last year has been quite the gift. Now it's sort of our job to take advantage of what is blood on the street, and the worst year ever for income and balanced investors. And those returns are worse than 2008 and any other year before. And parlay, what's been relatively modest losses into years of higher income and overall returns. The Fed does expect rates to um, keep rising between now and the end of the year, and then even into next year. But the reason I really put this here is just another warning to beware of forecasts, even from economists and policymakers. The Fed puts out its forecasts of its individual governors and participants, and it wasn't even a year ago that they expected federal funds rate to be less than 1% at the end of 2022. Uh, and this is a prediction of their own policy. So not only is it hard to gauge or forecast economic data, but it's even hard to forecast the policies that come as a result. So the Fed and the markets think those short-term rates will rise, and they'll eventually start falling again in the third quarter of next year when a recession hits. Again, if it hits, when it hits, don't know. Frankly, don't care so much about that. We're not hinging strategy and money on something as fragile as a forecast, but having cash and treasury bills maturing fairly soon, we get to repot it at higher rates. Our earnings generation and power, will continue to go up, at least for the foreseeable months and maybe even the next year. The trick is going to be to lock it in. More visual about the yield curve. So bonds of all maturities have gone up. This is sort of now in the blue versus a year ago and 2 years ago. So the ones that are really should be pessimistic are those who maybe not only put a lot of money in sort of high tech and crypto and some areas of the internet side of things that really were priced in Never Never Land, but also a lot of quote conservative investors who loaded up on long term bonds, especially as rates came down. Some people, as a way to keep some yield, only put more and more money longer term. And all things equal, it's a lot of time before one gets their money back. When you've basically have lent money for the long term, especially at a rate that wasn't even as high as inflation or perceived inflation, it's a risky proposition. And certainly long-term bonds and especially long-term treasuries can be a double-edged sword. Speaking of inflation, the inflation rates haven't, or expectations haven't changed much over the long term. I mean, markets and Fed and all, they expect inflation to come right back down to the 2% level fairly soon. And over the long term expectations haven't changed. So as yields go up, and this is the 10-year treasury, which is pretty pivotal, or pretty important yield. This is what mortgages are based off of. So mortgages of 7% today, don't happen unless the 10-year yield is rising. And but at least the yields now have some. They have what we call real yield. They have a yield that's above the anticipated inflation rate. Markets expect inflation to be, I think, 2 to 2.25% over the next 10 years. And so by buying a treasury at roughly 4.25, at least there's a prospect or a possibility of real yield. Here's a better maybe example of real yield. We've been buying a bit of the 5-year TIP, the inflation protected treasury. For most of the last 10 years, that yield has been negative. The real yield, meaning the yield on the 5-year treasury, especially when it was under 1%, and 1%, that was less than the market's own expectations of inflation over time. So all of a sudden we get a real yield. What this tells us is that we get a yield. I think today that number is more like over 1.7%, but we get a 1.7% real yield in the 5-year TIP plus whatever inflation is. And here's the nice thing about, and maybe the only reason I look at TIPS and look to buy them from time to time is there's very little downside. So TIPS have to mature no less than par. So if it's inflation, you get inflation on a 1-to-1 basis. It's added to the principal amount of the bond, and then when it matures, you get something above normal par, 100. It could be 105, 110, 115, 120. However, if it's deflation, it's not possible for these bonds to mature at 99 or 95 or 90 cents on the dollar. So I like this. This is real yield, and at least for the last 10 years plus, this is it's a respectable or decent real yield. And as a component of a bigger portfolio that's trying to hedge multiple risks and multiple objectives, I think these play a pretty important role, especially in the context of time. So maybe not my favorite bonds out there. There are a lot of bonds I think are really attractively priced, but on a risk-adjusted basis and as a role player for the longer term, I think these are a must. These are at these prices, at these yields, at these spreads. TIPS are a must. And if this real yield continues to move up, probably add only more to that. Switching to the stock side, just a quick showing of how bad sentiment has gotten. This is a pretty important sentiment polling. A lot of individual investors on this survey, and it shows that sentiment's arguably worse than during 08. Persistently negative, whereas in 08 you had pockets of hope and positive mindsets. This one, all things equal, this is good. Markets stocks don't bottom when sentiment is optimistic. So we're definitely oversold. The current rally makes sense, but sort of watch the psychology of this. This is another reason to maybe not be so pessimistic and start looking for buying opportunities, even on the stock side as well. Recession, inevitable, maybe. This is the 11th one if you count the 2020 2-month recession as being a recession. But this is a reminder that earnings do go down for the stock market. So when people talk about PE and PE of the market's only X, whether it's 17 or 15 or however they measure it, usually those PEs are thinking of earnings as either staying the same or even going up over the next year or two. So PEs can go up just by the earnings going down. And this is more of a bookmark or reminder of myself not to get too hung up on PE because companies' earnings will go down. That said, by having the ability to curate our own equity holdings, we obviously look for good businesses, and virtually all of them are somewhat are very much not cyclical. So a lot of our companies will grow earnings kind of regardless of the economy. They don't do something that's that economically sensitive. Doesn't mean their prices can't go down. They have, and they possibly will as if we hit recession. But our weighting is pretty low in stocks, pretty light, and if so long as earnings don't disappoint and they do what we think they do, prices go down. We, all things equal, should be looking to buy. Another reason why we should be looking to buy is, when stocks are down 25% or more, it's usually really good news for whether it's a year or more after. The returns are pretty favorable. I was surprised that there were only this many, 9 or 10 declines of 25% or more in the stock market since 1950. I would have thought there'd be a lot more drops of 25% or more. But time will tell. But we saw a year after the COVID effect on the markets, markets rebounded and then some. But we'll see. But this is encouraging, and it does pay to sort of look at this stuff and not get too sort of morose and pessimistic and doom and gloomish. Over time, if these companies, again, they raise earnings or they continue to grow, continue to add value to customers and stakeholders and grow those profits, the markets will follow. And same on the downside. If you have a terrible business with terrible economics, terrible earnings growth, markets will weigh that as well. And over time, you won't get a great stock price trajectory with a bad earnings trajectory of a company, and vice versa. So markets are fairly efficient, especially over the longer term. The inflation adjustments, this is real recent news. Maybe some a little bit of comfort as it relates to inflation. Tax rates, the tax rates are the same, but the brackets are increasing in terms of the income thresholds for various tax rates. So all things equal, the same amount of income for most people next year will have a lower tax rate. That's not true with FICA. As always, the income that Social Security tax eligible is going up again. Social Security, however, those payments, and last year we had a nice boost, 5-point-something% if I recall. That's going up 8.7% next year, and with a slightly smaller Medicare premium, I read. The inflation has also raised the contribution limits for 401ks, IRAs, and even some of the thresholds for when one starts to be phased out of of participating in a Roth. But here nor there, the employees and self-employed folk can put more money away on a tax-deferred basis next year. Anyway, I'll stop there. You know how to reach me if you have any questions. I'll sort of follow up with some topic-specific ones later that we think are pretty germane. But anyway, appreciate everything and hang in there.